Good morning, everyone. I am John Norris. I'm Chief Economist and Chief Investment Officer here at Oakworth Capital Bank. For all of you that are joining us through social media link or from LinkedIn repost or what have you, however you got here, Oakworth Capital Bank is a full service financial services firm headquartered here in Birmingham, Alabama, with offices in Mobile, Nashville, as well as Charlotte, North Carolina. We have our core competencies, which include banking, including full service commercial and private banking, as well as treasury management. Our wealth management offer includes full service investment management, full fiduciary services, as well as balance sheet management. And finally, our advisory services includes full service financial planning, as well as retirement planning and estate planning. We love what we do. We love our clients. And as such, our core purpose is helping people succeed. We do that by helping to redefine what success looks like in terms of financial services. And we do that by making all of our clients' lives, financial lives, easier. Now, with that being said, I do have some housekeeping rules I've got to go through. First off, everyone's going to be muted and your video screens are going to be turned off, or at least your cameras are going to be turned off. The chat function will also be turned off, but the Q&A button will be available. So if you have any questions throughout the webinar, please by all means jot them down and hopefully we will answer them with our comments during the presentation, but if not, we will do so there at the end. Now, as I mentioned, I'm John Norris. With me today will be David McGrath, who's the managing director in our Mobile office, as well as our chief equity strategist. David and I have known each other for longer than either of us would care to admit, going back to a previous employer and in a previous millennia. How about that, David? And then we also have with us Sam Clement, who's an associate managing director here in Birmingham, as well as portfolio manager. And truthfully, there's nothing that he can't do. Also on our investment committee that are not joining us on the webinar today are Chris Cooper, as well as Ryan Bernal. Chris Cooper is one of our portfolio managers and has a wonderful analytical mind. Ryan is our trader and analyst, and he is a lot of fun to have on our team. So with that, I've got one more thing before we really kind of open it up for the webinar, and that is our caveat. No lawyer made me do it, but I'm smart enough to tell you that nothing that you hear here today should be construed as an offer to buy or sell financial services or products. Any actions that you make based on anything that you've heard here today, you do so of your own volition. All right. So with that being said, again, reminder, nothing that we say here should be considered an offer to buy or sell investment services or products of any type. And our opinions and judgments are prone to change at any given time and without warning. So with that, I think I've touched on everything. I will make a reminder and another brief plug for Oakworth there at the end. So with that, why don't we go ahead and get going with what we're going to cover here today, and that's going to be we're going to talk about the domestic economy as well as the markets. Talk about what we're facing here throughout the remainder of the year. I believe the invitation said our crystal ball. Then we're going to talk about geopolitical events as well as really just overall asset allocation. Hopefully, how we can construct our clients' portfolios to maximize returns and minimize a downside. Now, that being said, I'm just going to start it off by saying, guys, last year about this time, we were looking into our crystal ball, and the path of least resistance, if you will, is really to forecast that the U.S. economy was going to slow down in 2024. I mean, after all, the yield curve was inverted. And historically, that has always led to slower economic growth. Things like the Conference Board's leading economic indicators were pointing to a slowdown. Really, just about every measure was suggesting, hey, we're going to have a somewhat cooler in 2024 than it was in 2023. And I felt as though I was almost sanguine in going out and telling clients and prospects that we anticipate the economy to grow 1.5 to 2% in 2024. And I thought that was a pretty decent forecast, pretty much along the lines of reasonable. However, doing what I do for a living, what we do for a living, guys, running across a lot of people that were actually forecasting negative signs in front of first and second quarter GDP numbers. These are people who have been doing it a long time. Their tea leaves are saying that the economy was going to slow down. And as we know, the official data here in 2024 has said anything but a slowdown in the U.S. economy. I mean, what was that? A 3% GDP reading during the second quarter. Currently, the estimates out of the Atlanta Fed are that the U.S. economy grew 3.2% during the third quarter. This on top of positive growth during the first quarter. So anything but a slowdown. So I guess we were a little bit more directionally accurate with what actually happened than a lot of folks. Even so, the strength was a little bit surprising to me and has been a little bit surprising to me. You know, why has this happened? Why have things been as good as they are, particularly when everyone has been waiting on the Federal Reserve to start cutting the overnight lending target? It seems like we've been waiting on that for 24 months. And David, Sam, I got to tell you, in my career, there have been a lot of meaningful economic releases. I remember getting back into this business back in 1991, a mercantile safe deposit and trust company up in Baltimore, Maryland, and we still cared about the federal budget. We actually looked at that we looked at the trade balance. We analyzed it to try to figure out what was going on, what was going to happen with interest rates. We cared about the Philadelphia Fed survey. We cared about a lot of things that, frankly, we just really don't consider terribly much anymore. They're tertiary reports. And I would tell you, David, you've known me for a long time, and you've heard me talk about originally it was the NAPM reports. Now it's the ISM reports on business. I love those reports as much as I can love any economic report. And those things have been historically important. I've already mentioned the Conference Board's leading economic indicators report. All of these things seem to really kind of fall apart over the last 24 months, seem as though they don't really make a lot of sense, or at least don't have the same correlation that they used to, because everyone is really focusing on two things: inflation and the labor markets, right? And the government, the Bureau of Labor Statistics, is going to tell us exactly what they're going to be, whether it's right or not. They're going to tell us what it's going to be every single month. First Friday of every month, we get the employment situation report. And during the second week, ordinarily, we get the consumer price index. Last week out of the month, we get the personal income and expenditures, and incorporated in that as the personal consumption expenditure deflator. And that is nerdy stuff, I admit. But we get all the data, and it seems as though that's all anyone has paid attention to. And as a result, these things are a little bit weaker than they were to start the year. And the Fed cut the overnight lending target by 50 basis points on September the 18th. Now, that being said, that out of the way, David, with everything that's going on, with the changes in the investment industry, the way that we look at data, what are you seeing out there? I mean, because it's hotter than we thought it was going to be. A lot of stuff still points to a little bit of a cooling, but inflation's not maybe exactly where we would want it to be, and it's hard to really kind of buy into maybe all the methodology. The labor market seems weaker, but the data isn't telling us that. 4.1% unemployment, 254,000 jobs last month. What are you seeing? What's going to happen in the remainder of the year? And then, is it going to slow down ever?
Well, you would think at some point the slowdown is coming in, and I think the labor market has slowed down some, but we were so hot as a labor market, unemployment rate at 3.5%, a little under 3.5%. I mean, it's come up. We're at 4.1% right now, which is, you could say it's the labor market is cooling some, but it's gone from white hot to hot. So, it has cooled, but it's still very strong. And John, you can go all the way back to the end of 2022 when most economists started calling for the recession.
Yeah.
And they really haven't stopped calling for it. And the consumer remains strong. We even got a retail sales number this morning that showed, that the consumer is still hanging in there. And I think, you can go back and look at what has worked over these last couple of years. Home prices are up. A lot of consumers were able to refinance and lock in a very low mortgage rate. So that has helped. S&P 500 is up 70% since COVID hit. So a lot of, the consumer balance sheet looks really good. There are some consumers that haven't kept up. And unfortunately, those people that didn't own a home, rents have gone up a little faster than wages. Food has gone up faster than wages. So we've kind of got a bifurcated consumer right now, where the bottom third, the bottom 40% of consumers are really struggling right now. The top 30% are doing quite well. and feel good and are still taking nice vacations. They're still buying goods. They're still going out to eat, going out to restaurants. So, the downfall of the consumer, I think, was greatly exaggerated. And, a lot of the numbers that you're looking at now, this is, knock on wood, hopefully will be the most bizarre business cycle of our career from the start of COVID to now. And we've seen some really bizarre economic data points starting to normalize a little bit, but it's until the consumer slows down, until that labor market really cools and we see maybe an unemployment rate over 5%, 5.5%, it's hard to bet that the consumer is going to slow down.
I mean, Sam, I think David hit the nail on the head. I mean, reports of the demise of the labor markets have been greatly exaggerated, which is actually an allusion to a man by the name of Samuel Clemens, not Clement, also known as Mark Twain. So not necessarily what do you think about that allusion, but what are you thinking about the labor markets? I mean, after all, I mean, they still seem to be kind of hot. The jobs that we're creating might not be exactly what we'd want, but is there any slowdown in terms of this massive labor machine?
There is a little slowdown, but you mentioned the demise is greatly exaggerated. That and it goes hand in hand, but that's for the labor market and the consumer. I mean, we're waiting for the consumer to as a whole to slow down significantly. And you mentioned it, retail sales number we got this morning. Again, consumers are going out to spend, and in fact, we've had consumer savings data revised higher. Well, hey, they still have some more room to run. There's still some more gas in the tank. And that parallels really well with what we've seen in the labor market. And so the demise has definitely been probably a little over exaggerated. And that's been the biggest driver, as we all know, for what's allowed the economy, the markets to really just continue to chug along is we've seen people still go out and spend. We are a consumer driven economy. Still nearly 70% of our economic output is based on consumption. That we are the biggest, strongest consumer economy. And that really hasn't slowed down at all. And I think that's where that prediction has been wrong, is that people have said, hey, it's two years now of this. Inflation is continuing to eat away. And David mentioned those haves and have-nots. And that continues to be the case. That's always going to be the case with inflation, is it's great for asset holders and terrible for those that don't own assets. And that divide is still continuing to happen. But even those lower end consumers, there's been some wage growth there. They are stretching their budget. They are changing their consumption habits to continue to go out and spend money on what is important to them. And that's a key part of what's gone on. David said this economic cycle is probably the weirdest, and it's hard to disagree with that. We've had really going back to COVID, this collapse in economic activity, this massive boom in economic activity, this shift in consumption habits that happened basically on a dime, where typically that would be something that would happen over years, decades. I mean, a long time for a US consumer's consumption habits to change. And so all of that has made this a weird economic cycle. It's made it difficult to collect accurate data as well. And so that's where we are, is this just kind of weird economic cycle. They say the bull markets and economies don't die of old age. And, are we starting a new one, or is this a continuation of the old one? And that kind of remains to be seen.
You brought up a very good point about the economic growth being a little bifurcated. There's going to be a little bit of a divergence from our run through, because you brought up a very good point that the bottom half, or let's say the bottom third, bottom 40% of the U.S. Households are probably flat on their back. If you take a look really at the CPI, take a look at the cost of essentials, sort of inelastic goods and services, those things really are uncomfortably high. It's almost like a snowball effect as well. You have the higher prices, you have the higher prices, you have the higher prices. You don't notice them at first. Maybe the frog in the boiling water might be a better way of the better illusion or analogy. But then all of a sudden you kind of take a look at things, it's like, I can't get out from under. Whereas conversely, I would say probably the top quarter of U.S. consumers and households are having a kind of a nice run of it. It might not be as white hot as it was a couple of years ago, but David, to kind of your point, the top quarter of U.S. households can grow 8%, and everyone else can grow nothing. And the way that we calculate the gross domestic product report, that means the economy is growing 2%. So when we take a look at things out there, Is this the reason why there's a disconnect between what the government is telling us in terms of economic activity, in terms of the labor markets, and the average American's perception of reality? A huge disconnect right now. You can go to Real Clear Politics, go to any number of websites, see direction of the country, and everyone thinks we're in the toilet. However, what the government's spitting out would say something completely different. You go to restaurants and bars in the tonier areas of town, they're pretty crowded. At the same time, the CEO of McDonald's is saying, "Hey, we're struggling here with a certain income group." David, how much longer can this continue before we start to see maybe a little bit more even, well, spread of the wealth, if you will?
You know, I think that leads to a really interesting discussion on the safety net we've built as a country for people that need it. And the cost of that safety net, I think, is going to be going up.
Yeah.
And you know, that is going to be the question, that in the timeline of that could be very long. It could be 4 years, 7 years. I don't think it's a 12-month situation where we find ourselves struggling with this. But you know, if you look at the kind of the upper class and the lower class, both have grown over the last 10 years. It's the middle class that is shrinking. And you know, the growing upper class has kept the economy moving. The growing lower class is the struggle. And how do we get more of those folks into the middle class, into a first home? And you know, it's not even the, you know, folks that are new to the workforce, they're finding it very difficult to buy a home. You know, with a mortgage going from 3.5% to 6.5%, and the, you know, the value of a first-time home going from 120,000 to 170,000 on the bigger mortgage, that's very difficult for those folks. And so that dream is kind of slipping away for a lot of people. And so, you know, how do we get back to kind of a normal situation? I think it's going to be just several years of kind of, you know, slowly chipping away at it, but I don't think it's a quick answer.
All right, Sam, kind of, I'd love to hear what you think about that. Being in a different generation that Mr. McGrath and I are, tell me, what are people your age feeling about the economy?
Well, I think you mentioned it, those polls generally about the direction of the economy are, I mean, historically bad. They are 2008 level bad in a lot of senses. These consumer confidence levels have been 2008 bad at a time where we all mentioned it. This is what, 9th quarter in a row of positive, pretty decent economic growth, and the stock market at all-time highs, and you know, gas is not too significant of a portion of people's budgets on average. So all of that, you would think people are saying, hey, things are doing pretty good right now, but it's kind of probably in the middle a little bit. I mean, yes, the government data, one, that's hard to calculate on what the person's budget is going up per month. I mean, John, you wrote about it before. Am I spending a 0.25% of my budget on salad dressing a month? Probably not. Things of that nature. So it's difficult to calculate, but also just sentiment is not always, consumer sentiment has not been in line with where things have actually been in people's actual lives. And so whether that's social media, whether that's an increased focus on politics, there is plenty of people, and anecdotally, I can think of some as well, who are in the best spot they've ever been in. Their net worth is at an all-time high. Their real wages are probably at an all-time high. I mean, there's lots of good things going on, and they will say things are terrible right now. So where the truth lies, it's probably a little bit in between, but it's hard to imagine so many people are so negative given their own situation being probably a little better than they would even admit.
I would tell you, I think that's probably due to the fact that a lot of people looking into their crystal ball, and I do have a crystal ball on my desk in my office, by the way. That's not kidding around. I do have one. But people looking in the crystal ball and seeing out there into the future, knowing that we're already $35 trillion in debt, we'll take out another 1.9 trillion, $2 trillion. Who's counting any longer? The Treasury this year, according to the administration's budget, which you can find at whitehouse.gov, go to table S2, as I know everyone already has. And you'll be able to see that the current estimates are given, modest inflation, modest GDP growth type numbers, the current estimates are the U.S. Treasury is going to rack up another $19 trillion worth of deficit spending over the next 10 years. So, David, you mentioned about how the social safety nets are going to be getting even more expensive, and they are. I mean, the majority of the growth in that deficit is Social Security, Medicare, and Medicaid, as well as servicing the national debt, which I don't think we have any politicians that want to touch the first three, and we can't not service the national debt. If we defaulted if the Treasury defaulted, it would cause a depression. I mean, an economic depression that would make the 30s seem like a little bit of a joke. So when I take a look out there and see this level of indebtedness, see how expensive all this stuff is going to be, although I might be relatively sanguine about the current rate of economic activity and kind of pushing us forward into 2025, where I think we might see some darker clouds. More on that in a second. Not necessarily what's happening in the United States, but what's happening internationally. When I take a look longer term, it's hard not to be perhaps a little bit less excited about the future, because that money is going to have to come from somewhere that Washington's using. And the truth of the matter is, it's either going to crowd out investment or crowd out investment elsewhere, or it's going to cut down on what the government can spend in terms of infrastructure improvements and other sort of discretionary things. So fiscal policy probably will be a little bit of a drag on the economy, or at least not the add that it has been recently over the next decade, and that will likely slow down the overall GDP number potentially by about 50 basis points. As bad as that is, and it's horrible, guess what? And this is probably politically incorrect now. I don't even know what's politically correct any longer. In the land of the blind, the one-eyed man is king. Okay, I admit that might be politically correct, and I apologize if I offended anyone. I'm old, and you're not in any event. So when I take a look at what's going on in the United States right now, I take a look at our growth, take a look at everything that's happening with our political dysfunction in a lot of ways, take a look at our massive deficits, everything that's going on, I still would contend we're a much better bet than the remainder of the world in terms of developed markets in particularly, but in terms of just financial systems, in terms of rule of law, and in terms of a lot of things. Now, the reason why I say that is because when you look at the remainder of the G7, a lot of them are facing some pretty severe demographic headwinds. Japan, notably, much of Western Europe, certainly. And then they are just not as flexible as the US economy. We beat ourselves up a lot, but we have a very entrepreneurial, very flexible economy that can respond to crises much better than the remainder of the developed world. Even that's not necessarily my biggest concern out there. My biggest concern is in the emerging markets, and specifically in China. I think it's India's, the next 30 years should be India's if New Delhi can get out of the way. I mean, truly, if New Delhi can get out of the way, the next 30 years should be India's room to run. However, in terms of China, we haven't heard that much about it here in the domestic press. However, those that follow it know that they have a major problem over there, a major problem with their banking system, a major problem with their housing market. I read somewhere that there is some 90 million housing units that are vacant. They can't sell them. Well, they can sell them, but the people that own them can't sell them. That's 90 million at an average of about $200,000 a pop. You do some basic math, and I've already done it, so it's not $18 trillion worth of loans out there that no one's going to repay. That makes 2008 here look like almost a cakewalk. You add that on top of the inflexibility that Beijing has in terms of just everyday life. And then Sam has brought this up several times. Two generations, for all intents and purposes, of the one child only policy. You've got not only financial headwinds, you've got some pretty significant demographic headwinds. And let's face it, China has been an economic engine, maybe the economic engine for the global economy over the last 20 years. It's grown at double-digit rates. Now the IMF is saying 4%. I think over the next 3 to 5 years, Beijing would love to have 4%. I think that's a very rosy outlook for the Chinese economy. I think we could actually maybe see some negative numbers. So when I take a look at that, I am far more optimistic regardless of our problems here in the United States, than I am the remainder of the world. Sam, talk me off the ledge. I sound like a xenophobe. I sound like I'm waving flags. Am I completely wrong here?
You're not wrong. And, you know, in the investing world, at least when you're talking about where to invest, it's a relative game, right? You know, where you're going to overweight and underweight. And comparing us to the developed markets, I mean, you're spot on. Several of these G7 countries are already experiencing negative growth right now. Meanwhile, we are, again, 9 quarters in a row of pretty strong economic growth. We have the most innovative companies on the world. We have the most free and open markets, essentially, and we have tons of demand internationally coming here because of reasons like that. And, you know, I've mentioned this before, but you poll US citizens whether it's a good idea to start a company or not, over 90% will say yes. And that is pretty uniquely American, especially in the developed markets in the G7 countries. In Japan, it's often less than 10%. Lots of European countries, it's in the 10 to 20 to 30% range. So we are a uniquely entrepreneurial country that have some of the largest, if not the largest companies on earth, that are the most innovative companies on earth, that frankly, these other developed countries they can't compete with us currently, given that landscape. And then China, the one-child policy is something that you can't go back and fix that. We've talked about Chinese stimulus policy recently and this kind of ready, fire, aim approach of just whatever we can do, spray it across the board, and let's try and pump the markets up right now. That doesn't fix the root issues that we already are experiencing and are going to continue to experience. And that's something that not just China, but any country that has these big population fluctuations, that's problematic for the economy. You need a growing economy. That's something the US is focused on, and immigration is a big part of that. And China is going to have to deal with the ramifications of that. And it's not something that some stimulus package can really go out there and fix.
You said a mouthful there. I mean, that's a fantastic response, David. You know, for long years, I mean, it seemed as though international investments were sort of a buzzword. You had to have them. Do we need to have them?
You know, I think a lot of the studies that showed all of the great diversification benefits were in the mid and late 80s, early 90s. You know, if you look at the S&P 500 last quarter, 47% of revenue came from outside the US. So even if you just held the S&P 500, you want other countries to be strong because they're buying a lot of our stuff. So we're still getting some diversification. I do think it's not a bad idea to have some, but you look at a lot of institutional managers, they'll have 40-50% of their equity in international. And I just think that is a pretty heavy weight. So I'm not quite sure you need that much. I do think it's a good idea to have some. But going back to what you said in the beginning of this little piece, that we're still the best house on the block. And I love the fact that we have regulations the way we do, the accounting standards that we do. Feel a whole lot more comfortable in those type of situations than I do maybe going outside the U.S.
Well, in terms of going outside the U.S. and talking about just geopolitics, just in general, I believe that you know, when you take a look at what the future, I believe both political parties, but particularly the Republicans and Donald Trump, talking about slapping big fat tariffs on things. This has been relatively new. I mean, it's we went through what three decades of free trade. Now we're talking about tariffs, and particularly on China, but then also even on Mexico and others. How is this? How's this not inflationary? That's what I can't wrap my brain around. How is this not inflationary? And then, I mean, why does it sell? I mean, we kind of take a look at it. I guess I get it a little bit. Hey, we're going to protect industries, but historically, we've proven time and time again, I think, that when you protect inefficient businesses, it doesn't make life any better for both the economy and the consumer. So why is this so politically popular, and will it work? David?
You know, I think it sounds better than your taxes going up. If we're going to raise money from,
So?
you know, I think that is one positive. And I think the threat using some tariffs and then the threat of additional tariffs may give some leverage in negotiations with trade going forward. So I do think a lot of things are inflationary right now, John. So I don't know how it's not, but I do think that tariffs are probably here to stay. And if nothing else, it gives some leverage on, we have the ability to go higher.
Sam, tell David he's wrong, but I don't think he is.
He's not wrong. The key to have tariffs possibly work at all is what are you tariffing? If you're doing across the board, that's not going to be great. If you're, if you're tariffing industries you want to keep and you can be competitive on, that's one thing. But if you're going to do across the board tariffs, that's not going to work. And David brought up a good point. Is this kind of a negotiation starting point? I mean, we've seen tariffs enacted, right? But does this incentivize businesses to onshore more? I mean, we could talk for another 30 minutes on the benefits of onshoring, especially given the new geopolitics kind of events going on of late and that are going to continue to occur. So there's definitely benefits to incentivizing companies to bring things back to America. But the big question is they have to be things that we're competitive on and want to be competitive on.
All right, that's a great answer. Now we've kind of covered geopolitics and domestic, well, not geopolitical events and just the world as a whole, as well as what's going on in the United States. And we haven't touched yet on the Federal Reserve, which is what everyone likes to talk about now. And then we'll touch on asset allocation. And we've got about 4 or 5 minutes before we kind of open it up for questions and answers. So if anyone listening has a question we haven't addressed yet, please, by all means, do so pretty quickly. When we take a look at the Fed funds futures market at the Chicago Mercantile, it's telling us that the Fed is on an easing cycle. We will likely get a 25 basis point rate cut at the November 7th meeting, and then another one 6 weeks later in December. This would take the upper range of the overnight lending target to 4.5%. And then in 2025, there's some estimates out there that we could end up taking the overnight rate down to 350, 375 in that range. That would obviously be a pretty big change, really, all things considered. David, how does the Fed get there when the economy is growing 3%, 3.2%, when inflation is still out there and the unemployment rate's 4.1%? I mean, it doesn't seem to make a lot of sense, but at the same time, if you were to make me bet you $10 where the overnight rate's going to be this time next year, I would probably say 3.5 to 375. I mean, how can this be?
I would use another old adage: be careful what you ask for, you may get it.
Yeah.
I think if we have a Fed funds rate at 3.5%, that tells me the labor market has weakened significantly. That means the consumer is probably pulling back, and that means corporate earnings are probably going to be lower than what we're projecting right now. So I think kind of a happy medium is a labor market remaining relatively strong, looking at historical levels, maybe not looking at the 3.5% unemployment that we had last year, but keeping it with the 4 handle on unemployment, having earnings still be good. I think that may prevent inflation from coming down as quickly as the market would like, and I think that may prevent the Fed from being as aggressive in bringing down the Fed funds rate. So I wouldn't mind maybe a 4.25 at the end of next year for a Fed funds. That tells me the economy is still relatively strong.
All right, might be a $10 bet on that. You say 425, I say 375. Sam will tell you it's going to be 4%. He wins. All right, we'll both give Sam $10. All right. Now, with that being said, Sam, I'm not going to follow up with you on that because we're running out of time. I do want to hit on asset allocation just a little bit again. Nothing is an offer to buy or sell investment securities, and anything you do at your own discretion. The biggest bets that we have made here at Oakworth Capital Bank over really the last couple of years have been to overweight equities relative to bonds, and then overweight international relative to, not international, overweight domestic relative to international, and both pretty decently compared to the benchmarks that we're using and the peer groups that we're using. And this has worked out very well for us and very well for our clients. What is out there in the crystal ball, Sam, to say that we need to change anything drastically what we're doing?
Well, the equities, the equities over fixed income and cash, that's going to be, we all know that's going to be the largest driver of returns is those kinds of bets. Even less about international versus domestic and then sectors and names. All that is less important than how much are you going to put into equities versus bonds and cash. And that's been the right call in an inflationary environment. It is the right call. I mean, people get scared of equities, I think, in an inflationary environment. But the great thing is, inflation can be great for companies. I mean, these are real earnings. They have real earnings growth during inflationary environments. Inflation is terrible for bonds, and supply is terrible for bonds. Extra supply is terrible for bonds. So there's a lot on the horizon that we've talked about. This $19 trillion in new debt over the next decade. Inflation is still not at 2%. I mean, you are having purchasing power eaten away at these nominal yields. And so all that to be said, we're still in an environment where equities are a better asset class than fixed income by and large. And so that's something we focused on. And like you said, it's been the right call. And the US versus international, again, goes back to don't need to say too much about it. Relatively speaking, the US is in a much better spot than almost anywhere else in the world.
All right, David, Sam made a pretty convincing argument, or kind of backing up our collective argument on what to do. Now, within domestic, it's kind of hard to not like some other asset classes which have not performed quite as well over the last several years, knowing that technology, and more particularly some of the biggest technology companies, have really been behind a huge chunk of the market's rally. That seems to be changing a little bit, but wouldn't now seem to be a pretty good time to maybe consider value and consider small caps for the first time in a very long time?
I would agree 100%. I think looking back on the environment we've been in, and going back to the opening statement, talking about looking for a recession for the last 2.5 years and not getting it, a lot of the smaller stocks had priced in that recession. We were trading at 13, 14 times earnings on the small cap index versus 23 for the S&P 500. The closer we get to either a soft landing or a no landing, means those valuations have a chance to come up. And the other issue, all the debt we're talking about, interest rates probably will be higher for longer. That's going to take away the tailwind that growth stocks have had for the last 20 years. So I think we may have a slower growing economy, but a more balance between growth and value, and an environment where smaller stocks can actually participate in the rally, unlike the year and a half that we've seen.
All right, thank you for that. I think it's a fantastic answer. Now it's time to move into the Q&A. We already have a few lined up. Charles, I do want to touch yours first. I'd love to stay away from any specific recommendations regarding any particular Indian companies or any big exchange traded funds. That just gets a little bit too granular for this, and that does really kind of means that we're out there pushing a product, and we'd rather not do that. So there are any number of companies out there and exchange traded funds. I would probably be more inclined to use an exchange traded fund or a mutual fund than any one specific country, understanding that when you buy a fund, you're eliminating a lot of unsystemic risk and not understanding the Indian financial system quite as well as anyone would like here in the United States. I think that's just really kind of the safest approach. And there are any number of them out there. Now, with that being said, the Indian market, we're not alone in thinking that it's going to be India's room to run. And it's not maybe as cheap as it has been. It's rallied quite a bit too. So any form of pullback significantly in the Sensex would be probably a decent time to buy. Now, I'm not saying going out there and buy 20% of your portfolio in India, but India specific, nibble 2, 3, 4% at first, see how you like it, and then add from there. So try to use a fund as opposed to any individual companies, in my estimation. Now, one of the questions out there from anonymous attendee is, you mentioned population problems that having an impact on China. What about all the people streaming across the border here in the United States? 20 million influx of people here. Let me start by saying that immigration has always been a net positive for the U.S. economy. Always. Everyone's here as a product of immigration. So I'm not worried about long-term people coming to this country and taking jobs that no one would want to do. That's historically the way it's always been. And that's historically going to be the way it always is. with the influx that we've had here, we just simply having that many people come through. We can't vet them all. We don't know what diseases they have. We don't know what skills they have. We don't know their criminal histories and what have you. So bring on people that want to come to this country and work hard. I mean, by all means, bring them on. That's why we're all here, and it will be a boom for the U.S. economy. Bringing on that number of people, and we don't know where they are, what they can do, and whether or not they're sick or not, that's a little bit scary to me. So overall, and theoretically, in a perfect economic vacuum, 20 million people come to the United States means 20 million people that that need to work, 20 million people that need to be clothed, fed, shod, and housed. That should be beneficial for overall economic activity. David, Sam, your thoughts?
Yeah, no, I agree 100%. I do think the housing issue is larger now than normal since, with mortgage rates where they are. And I see a couple of questions on mortgage rates, so maybe we can delve into that after this. But, I do think you have 15, 20 million people all needing a place to live, and that is going to help drive the cost of rents up. So I do think that is going to be an issue over the next couple of years that will have to be addressed. And I'm not sure that sinking mortgage rates are necessarily going to be, if that where that comes from, because I'd love to get John and Sam your thoughts, but I think mortgage rates are settling into kind of a normal, maybe a 6% type of range. I hard to believe we're going to go back to the sub 5% mortgage rates anytime soon. And especially if inflation remains a little hotter than expected, I think we're probably getting close to where that long run mortgage rate is going to stay.
I mean, Sam, your thoughts, but to make it kind of short, we've got a couple of other questions.
Just mentioning the bond yields and mortgages, those rates are probably going to converge to a little more historic norm, that 10-year to mortgage spread. But I think we would probably lean more on that being the 10-year kind of ticking back up rather than mortgage rates coming down too significantly. I just can't. 6.5%, 7% doesn't seem that egregious for consumers to go out and borrow money for 30 years, given the current environment and the economy being where it's at.
Yeah, Warner, I see your question, and I kind of agree with these guys. I think we're probably in sort of a range with the 10-year. And I'm going to tell you what I think is going to happen. If the 10-year does get back up to 5, which could happen given all the supply and the fact that I don't think inflation is going to fall terribly much more. If it does get back up to 5, you're going to see the Federal Reserve add to their balance sheet again. If not that, then they will quit quantitative tightening. They've already slowed the pace of quantitative tightening down. So we are going to see the Fed put a backstop on longer term interest rates. They've done it before. They're going to do it again. And if nothing else, they're just going to try to keep the Treasury's debt service down. So I do think that the Fed will play shenanigans on the yield curve if we do see rates blow up the way they probably could or should. And at the same time, the supply is going to should keep rates a little bit higher than what we would like. So, when we take a look at the 10-year, I feel comfortable in a relatively broad range of 4.25 to 4.75, sort of longer term. And it would take really a very big economic downturn to change that estimate in my estimation. Another question that we have is really kind of about the markets just in general and how much cash you need to have. And I think 2 or 3 are about the same. What should you be doing during a downturn? What are the cash needs? Because at some point, certainly we'll have another downturn. And Sam and David, I will answer these questions, which I'm kind of combining because we're running short on time. And we need to ask, people need to ask themselves, how much are you comfortable with the downturn? Is a 10% downturn in the market going to impact your way of life? Is a 20% downturn going to impact your way of life? If those answers are, no, probably not too much, then don't agonize over it. I mean, I know I'm being cavalier with someone else's money, and I'm not trying to be. However, that's really kind of the litmus test for how much risk you should be taking. If the prospects of the market going down 10% keeps you up at night, you probably need to take some money off the table. I mean, truthfully, if it doesn't keep you up at night, then you probably need to maybe add a little bit more risk to it. I mean, that's kind of a vague way of answering that. Don't sweat what historically happens with some regularity. And also, while we have downturns, and we have always had downturns, the markets historically come back. If you were to take a look in 2008, as awful as that it was, David, was that 28 months later you had all your money back? In 2022, as awful as that was, it was a horrible year. Everyone's got all their money back and then some less than 24 months later. And you go back time and time again over history, and you see that happen. If you feel as though you really can't sleep at night, you want to take some risk off the table, by all means do so. But don't let sort of a short-term disruption of the markets that's not going to impact your way of life dictate how you manage your money for the long term. David, Sam, am I wrong?
Oh, cash is really kind of I view it a little bit partially as a buffer. You know, if you're in a point where you're having to spend down your portfolio, a little cash is nice to where you can ride out the swings of the market and also buying opportunities. So that's kind of the primary, I think, objective for cash.
Yeah, David.
Yeah, now I just want to touch, and there's one other question on here talking about what would Oakworth do to protect the downside if we do see some dark clouds on the horizon. I think that's a great question.
Yeah.
And I think right now, if you look at the S&P 500, it is more overweight growth to value than even the tech bubble of early 2000. And so I think if you look at our asset allocation right now, we're about even between growth and value, which is a significant difference than the overall market. And I think if we do see a massive slowdown in the labor market and the consumer starting to pull back, we would definitely allocate to more of the things the consumers need versus what they want. And those are the defensive sectors of the market. Utilities, people are going to heat and cool their home. They're going to buy their medicine, and they're going to buy their consumer staples, you know, toothbrushes, toothpaste, deodorant. You know, those basic necessities, those defensive sectors usually hold up very well in a down market. And at that point, we would go a little overweight on shorter term fixed income to try to protect the downside.
You know, great answer, David. And I'll kind of finish it up with this before we go into sort of last thoughts. You know, also please remember that at Oakworth Capital Bank, our interests are perfectly aligned with our clients. I mean, it's just going to tell it the way it is. Business wise, the more money our clients make in terms of rates of return, the more money we make. The less money we make, or if assets value fall, the less money we make as a company. So we are going to do everything that we possibly can in order to maximize the rate of return that you get while minimizing or mitigating your downside risk. Our interests are perfectly go hand in glove with that. Now, if we feel as though there's going to be an permanent impairment of U.S. assets, by all means, we're not going to pay too much attention to the tax code. We are going to go ahead and protect as much of your money as is possible. So, you know, short-term disruptions in the markets, a 5 to 10% sort of downturn. We don't want to go out and realize 28% capital gains tax consequences for clients, but because we're worried about a 5 to 10% sort of decline. So everything that David said is absolutely spot on, focusing a little bit more on value, focusing on a little bit more inelastic economic sectors and companies would be our first way of minimizing downside risk. All right, Sam, I'm sorry I didn't get back to you on that, and questions keep coming in, but you know, we have our marching orders to cut it off at 9:45, and it is 9:45. So you can see that nice screen there. Connect with us. If you've liked what you've heard today and you aren't familiar with Oakworth Capital Bank, or even if you are familiar with the bank, but not necessarily familiar with our investment team or wealth management offer, please, by all means, go to oakworth.com, OAKWORTH.com. Play around in there, find out look at some of the bios, read a little bit about our history, but by all means, go to our thought leadership tab. It's towards the right-hand side of the page. Go down there and scroll around. You will find links to all kinds of exciting information, including links to the podcast that Sam and I co-host called Trading Perspectives, which comes out mostly every week. I think we try to get 50 out a year, as well as links to our newsletter/blog. It was a newsletter when I started writing it 20 years ago. Now it's a blog because that's the verbiage that we use. So I still call it a newsletter/blog. Common Sense, which is a little bit different than your standard weekly rag, from a lot of firms, try to touch on topical things and how they'll impact your daily life. And then finally, recently out, our brand new quarterly magazine and analysis report called Macro and Market. Really good stuff in there. Go on there. You can find all this and more, including pieces from our financial services group that has some really good stuff out there. So please, by all means, go out there, play along with it. Like what you see, like what you read, like what you hear. Please feel free to give any of us a shout. Our bios and our contact information, again, are on the website. Of course, I'm not going to say this again. I've already hit on it once or twice, but there you have it. There's the caveat. I'm going to hold on for just a second, let people to read it before we say goodbye to them. All right, if you've gotten through that, gang, thank you all so much for participating, listening. Thank you for the questions. We appreciate it. We love doing what we do. We love doing what we do at Oakworth Capital Bank. That's part of the reason why our net promoter score for the company as a whole is in excess of 94, which is outrageous. And then also we have been named the best bank to work for. I know that's a bad way to end a sentence. We're bankers, not English professors, but we have been named best bank to work for 6 years in a row by the American Bankers Association. It just kind of shows you that we love it. We love our clients. We love doing what we do. So thank you all. And I hope that you make our next webinar, which will be at some point in 2025. David, Sam, say goodbye.
Thank you, everyone.
Y'all take care.